Gabriela, a lot of that growth will come from Latin America in contrast to this year where Asia was really driving everything.
Exactly. So if we think about where emerging markets have been, it was super tough years, 2011, 2016. Then growth started to bottom last year, improved this year, really led by strengthening Asia and emerging Europe, I would say. But if we think about what's really going to change for next year, I really think that's an acceleration in Latin America from mediocre growth to trend growth.
So the story will be that the growth is expected to pick up in Latin America, and that will translate into outperformance of LATAM EM assets.
Correct. And I would say especially on the equities side, right? So we should expect a translation to solid earnings growth next year. Valuations generally reasonable. And then if we think about local currency bonds, still a solid story there with inflation levels very low, central banks still in easing mode.
Something we hear a lot from guests is that with particularly a lot of the Asian EM outperformance, a lot of it is tech. And so not these sort of EM companies of old, like some giant coal company or something like that. When you look at LATAM, is there any industry that particularly excites you?
It is not the industries of old in the sense of commodities either. And actually, a lot of the indices in Latin America have been changing a little bit. They're not so much commodity heavy. They're a little bit more exposed to things like financials and like consumer names. And so if you think about a region that's starting to rebound, it is those cyclical, domestic-oriented sectors that tend to outperform. Is there a tech sector in Latin America? There's pretty much, if you look at the index, there's just one company or so. It's not where you go for that tech exposure, really. I think it's more about just the solid consumer base you have and the rebound in credit growth.
We still see political risk, of course, in Latin America. This week is all about Peru. We don't know what's going to happen in Brazil next year in terms of who's going to be on the ballot or what's going to happen with that. How concerned would that make you about your forecast? So it's definitely going to generate volatility, I would say, when it comes to asset prices. What tends to happen, and we've seen it this year, right, in the lead up to a political event in emerging markets, you see a huge run up if the business-friendly candidate is leading in the polls, and then you see a crash if things go the other way. So it is very volatile, but I don't want to underestimate the really solid undercurrent of growth going into next year for the region, which is a really solid base when you think about earnings, when you think about fundamentals for companies. But the way I think about it is we've planted the seeds for that rebound next year. Does the election outcome, is that kind of watering that seed, or is it kind of pesticide that really disrupts the more long-term picture for the region? Yeah, kind of bifurcated there. It's very bifurcated. It tends to be, right, very extreme candidates and very different outcomes. Well, so let's talk about perhaps one of the biggest markets in Latin America, which is Mexico, which of course has its own presidential election next year. How does that fit into your thesis that EM and LATAM EM will be leading the way? So it's always kind of a story about ex-Mexico. Because it is a very, very different economy. It's a manufacturing economy instead of a more commodities-focused one. That was an asset back when commodity prices were falling. So Mexico has been much more stable than the other countries. It's not a story about acceleration from a low. And then Mexico has always had that exposure to the U.S. instead of China for the rest of the region. Again, something that was an asset in the past, for the past few years, but has become something a little bit more difficult. A little bit more difficult because there is that NAFTA tension that continues. Oh, yes, that little thing. So we've obviously seen up until this year many years of EM underperformance. I think it peaked relative to developed market like 2011. Was it 2011? Historically, can the upcycles last just as long? Like when you go back for the long sweep of history, what does that tell you about how long this could go? The thing we think is most important when you're comparing EM versus DM performance or potential for performance is the gap between EM and DM growth. So we're really used to thinking emerging market economies grow faster, and they do, than developed markets, but how much faster? And is that gap closing or expanding? That's really what dictates outperformance. And then to what extent does it still matter, say, the liquidity cycle being driven by developed market central banks? And so you hear they're easing, and so you go far out on the risk curve, and that's good for EM. But if the story is now tech in Asia and strong financial and consumer sectors in EM or in Latin America, does that make it sort of less sensitive to the classical easing cycle that we would have seen in the past?
I believe so. So if we think about the taper tantrum in 2013, when we first started thinking about withdrawing that liquidity punch bowl, and then emerging market assets had a very stressful time, that was really when investors were only going to EM to chase the yield, and that was it, right? It was very technical, very temporary. Now it's very different. It's about the growth, it's about equities, it's about fundamentals. So I do believe it makes it much less sensitive to whatever the Fed may or may not do, or the ECB does. It's much more solid.
So in terms of where you want to be, you mentioned equities several times. So clearly equities is at the top there if you rank it. Then what? Local currency debt?
Yes.
And finally, hard currency debt. Talk about why that part is played out.
Yes, because if we think about exactly the story, right, investors were going to emerging markets just looking for the yield, and they didn't want the currency exposure. So they wanted hard currency, US dollar debt. So those spreads are incredibly tight and expensive. And when you have US dollar assets, right, they're directly vulnerable to Fed rate hikes.
Yeah.
And EM debt has fairly high duration, whereas local currency debt is much more about what local central banks do, and a lot of them are easing in emerging markets.